This is Business Breakfast. It's really great to be here with you on this Friday morning. Plenty to discuss with my guest host, Stephen Goldman. He's from Capstream Capital. We're being joined by Alex Douglas. So he's from Monex. What we want to talk about are some of these wild swings that we've been seeing, this volatility. In and amongst that, we've seen investors developing a really strong home country bias, really sticking local when investing and potentially, I suppose, missing out on some of these international markets. So, Alex, you're from Monex Securities. Not everybody is obsessed with these day-to-day machinations of the markets. They're looking at things sort of more broad-based. I mean, how do you view this volatile period that we're in right now?
Well, it's certainly volatile, that's for sure. But I think, getting back to what you're talking about, the home country bias, Australians are perhaps the worst in the world when it comes to home country bias. They like to invest very much in Australian companies. And obviously one very good reason for that is the preferential tax treatment of dividends. That's been a big driver of it. But for Australian investors, it has traditionally been very expensive and difficult to invest offshore.
More.
It's not. Technology is making it much easier. People are used to trading online now, been doing it for 15, 20 years. Now we're getting to the point where some of the online trading platforms like Monex give you access to numerous markets, all just with a click of a mouse. So, with Monex, for example, you trade 12 different markets.
Yeah, but why would an Australian investor want to be looking offshore now? I mean, I think the problem is that a lot of the offshore names that Australian investors are familiar with are the FANGs, the Netflix, the Facebook,
sure.
The Alphabets, all those.
Yeah.
Why would you want to be buying into them at this time?
Those particular ones, certainly. They've had a very good run, and they've been hit quite hard in the correction we've had in recent days. But that's only one aspect, one small segment. There's a plethora of opportunities out there, and in the Australian market, you're limiting yourself to less than 2 or 3% of global market capital, and you've got an Australian market where the market is made up by financials and resources. And so you have a lot more opportunity if you do look overseas. Yes, there are the FANGs that grab all the headlines, but there's even the Australian company Atlassian, which if you want to invest in that, you can't do it in Australia. You've got to invest offshore. It's listed offshore. Or if you want to get involved in electric vehicles or artificial intelligence, some of these things, it's much harder to access or to get exposure to those parts of the market within Australia. So investing offshore, now that it's so simple, it opens up all those opportunities.
But apart from the simplicity of going and doing it, where should investors be looking offshore right now, given that we are seeing, broadly speaking, rising bond yields, given that we've had such a run in the FANGs, given that we have this volatility? It's all well and good to say that investors should be doing it and that it's easy to do it, but so what's the strategy?
Well, look, I think as we've seen in the last few days, equities, securities as an asset class move, up and down together around the world, wherever you're investing. So I wouldn't suggest you put all of your assets into equities, whether it be in Australia or the US or China or wherever. But you can diversify your risk, or reduce your portfolio risk if you diversify into some of these other geographic regions, and you can get access to areas of the market that you perhaps don't have access to here.
Well, sounds like it makes good sense.
I think there's one other thing that I look at when I invest offshore away from Australia, and that's the currency. And yes. I think of the Australian dollar as a risk-on currency, maybe commodity-based, that will perform well when things are going well. So you have a situation like we have now where maybe equity markets aren't doing that well. Well, the Aussie dollar is also weakened. So if you're invested in these offshore companies, they're denominated in US dollars, for example, you get somewhat of a hedge by being in the US dollar. So it does dampen your volatility in these risk-off type environments.
And
so that's why I like
the FC. If you'd been holding your assets in American stocks or in Japanese stocks, the declining currency would have, to a large extent, offset the losses that you had, and your financial position overall would have remained. It wouldn't have offset the whole thing entirely, but it certainly would have made a big difference.
We were talking before the break about U.S. economic performance. So if we're talking about the Australian dollar, obviously greatly impacted by the U.S. dollar. We saw the U.S. dollar rising through the overnight period. I mean, do you still have a forecast for the Australian dollar to continue to weaken, and how low do you think it will go?
In the short run, there'll be continued pressure on the Australian dollar, but that's really versus the U.S. dollar. I think it's more of a U.S. dollar story than it is anything related to Australia. In fact, if you look at the Australian dollar versus, say, its Asian trading partners, it's performed relatively well, just not versus the U.S. dollar. It's been a more U.S. dollar rally story. Look, the economic data out of the U.S. has been fairly good. It's continued hiking rates, so people want to be in, well, a higher yielding environment. So that's supported the U.S. dollar over the more recent term. The question is, over the longer run, whether those trends continue. I think there are some risks to the U.S. dollar, particularly with the trade war, and at some point rising rates also negatively impact that corporate profitability story. So it's hard for me to say where it's going to go in the longer run, but in the short run, the Aussie dollar should remain under some pressure, like the rest of Asia.
Yeah. When it comes to the U.S., we were speaking with Chris Weston from Pepperstone a little bit earlier. You know, he was raising a few red flags around some of the data points, but we get this GDP read out in the U.S. I know Capital Economics, just going by memory, has about a 3.3% annualized growth rate expected to come through in the third quarter. I mean, that's quite that's solid.
Well, it's a solid story. It's been for a fairly long period of time. I tend not to focus on things like GDP. They tend to be backward-looking data. So, okay, it tells you how you historically perform. Great. I think more worried about the future corporate profitability, but future inflation. And when you look at what economists are forecasting for inflation in the U.S. over the coming years, it's not a big pickup from where we are today. So I think what we can say is, since the GFC, it's been a good economic recovery, just not a great economic recovery. And I think that continues. It's a good story. 3.5% GDP is a really good story. It's a non-inflationary story still. And then what I would say is, with regard to the Fed, there's still a lot of question marks internally in the Fed. There's no consensus on where the Fed wants to be in the longer run. So it's kind of a wait and see. The Fed has always said data dependent. So the truth is, no one knows, and we'll have to wait and see what the data shows.
Do you feel that there are some as to the inflation trajectory?
I don't.
But a lot of people do.
Yeah.
Why don't you think?
Well, I think in the end, longer-term inflation is going to be driven by worker wage gains. And I think in developed markets, those are constrained. The workers don't have the bargaining power that they had in the past. Even here in Australia, where average wage gains are somewhere in the 2.1%. So wage gains are failing to keep up with inflation. And really what that means is the consumer will remain under pressure. And the problem for that is, in any developed market like the U.S. or Australia, consumer is 2/3 of growth.
Yeah, all right, and that's why these U.S. earnings are so important as well, to gauge how the U.S. consumer is feeling. All right, so we've got an interesting session, no doubt, ahead here in Australia, given the falls that we saw yesterday. I mean, do you think that we'll likely see some moving in, or, as we were speaking with Chris Weston earlier on, saying that, you know, you could see some selling into any strength that potentially comes through, particularly maybe in that financial space? I
do tend to agree with Chris. I think we're going to have a fairly volatile period. You know, we shouldn't get too excited about one overnight rally in the US. Yes, we might get some gains here, but it has been a fairly substantial correction. They say that even a dead cat will bounce if you drop it from a great enough height, so let's see.
All right, we'll leave it there. Thank you so much for coming in. Really appreciate it, Alex, from Monex. We will be speaking with you in a couple of weeks.
Great.
Mr. Douglas. All right.